Welcome to Scalpers University Module 2, Systems and Execution. This is Lesson 2, Risk Management. So, start with Rule 24, which is risk-reward, not reward-risk. You want to really focus on the order of this. It sounds simple, but most traders, where they mess up at the beginning is the focus on the reward ahead of the risk. So they go into a trade with their profit target already predefined, with no consideration for the potential drawdown they can take on their trade or where their invalidation is. It's a common thing. It's a very retail way to think that when you buy Bitcoin at 40k, you only buy it at 40k because you want to sell it at 50 or 60 or 100 or whatever. But you must, to change how you trade, to become a better trader, certainly to become a short-term trader, you need to define your risk initially and always start with that. Start with, where am I wrong? Where's my invalidation? Where is my point at which I would have to cut the trade or potentially consider cutting the trade? And then from there you can find out what your potential for upside is. So in terms of risk reward, we think and speak in terms of R. So if you're in the group or have followed me for any period of time, you'll know I do everything in terms of R, which is essentially just a way of calculating the percentages or the increases or the ratio of risk to reward. All right, so you can see there that R is equal to risk, which is essentially how much that you risk per trade in either dollar terms or percentages. You see the example here of a 2-hour trade, which is an entry at 40, stop loss at 39, and a profit target of 42. So that's a nice simple example where you have $1,000 $1,000 risk and $2,000 reward. So obviously that's 1 to 2, which is a 2-hour. Now, framing each trade like that is just the absolute basic must do for you to be a successful trader. We'll get a bit more in depth now with Rule 25, which is always to remember what risk really is. So I want to cover first the misconceptions of what risk is, because that's probably what most of you have already got in your mind and is something that you want to clarify first and clear out before we move on to what risk really is. So risk management is not just having a stop loss. So you can't just put a stop loss on a trade and say I'm managing risk. It's not risking an arbitrary percentage of your account balance per trade. So, you'll hear a lot of people say risk 1%, 2%, 3%, 4% per trade. That in and of itself is not risk management. Don't get me wrong, that's not an incorrect way to think, but it's much, much, much too shallow of a thought process to truly be management of risk. Okay? Because a lot of traders don't realize that if I say risk 1% of your balance, that does not mean put your stop loss 1% away from current price. All right, so the risk management needs to be expanded upon a little bit from that. And also, if we talk about risking your balance, so if you understand that means your portfolio, so if you've got 100,000, 1% of that is 100. It's 1,000, then I can't just say to you risk 1% of your balance without giving further context, because then you'll just put $1,000 as risk. But where is your invalidation point? Where is your point of reward? So your risk to reward. Also, what type of trading are you engaging in? So you have short-term scalping, you've got day trading, you've got swing trading, you've got position trading. Also, considering the size of your portfolio and how much you're allocating to that trading strategy will determine how much percentage of your portfolio balance that you should risk per trade. You can't risk 5% per trade if you're a scalper, because you might be taking 10, 20, 30 trades a day. All right, so that might seem obvious, but a lot of people are actually risking 5% of their balance per trade on a day scalping, and we'll see in a further slide how quickly those losses can add up and just destroy your account. So a little more context is needed for that, and it's a common, it's like a conventional wisdom I see that I feel is wrong. So risk management is also not cutting trades early because you feel that it's going against you. Again, retail inexperienced traders think that management of risk is, to cut a trade early. That's not managing risk. That's reducing risk. Sure, you could see it that way, where if you're cutting it now and it might have potentially went lower, yeah, you've reduced your risk. But if you were truly managing your risk, there would be no need to cut it, or you wouldn't be cutting it just because you feel it's going against you, okay? So there's nothing wrong, as we'll see moving later on, there's nothing wrong with cutting a trade early if it meets a certain set of criteria, but you can't just do it because you feel like it's going against you. That's horrible risk management, because over time and over a large number of trades, that's going to lead to bad habits, bad decisions, and more lost money than wins. Because, very quickly to mention, if you've got a trade like the one on the previous slide, this one, if you've got a trade entry at 40 and a stop loss at 39, and that's a properly defined invalidation, let's say, okay, and your target's 42, well, if price drops down to 39,100, your trade is still active, it's still valid, so why would you cut that early? With just imagine there's no other context, just because you feel it's going to go to 39. But the only reason you set that stop loss to 39 in the first place and have that $1,000 of leeway is because you might suffer drawdown before it goes up. It could go all the way to 39,001 and then reverse and go to 42, and your trade was perfectly fine. So if you have an invalidation and you understand what invalidation is and you understand the value of a stop loss, you don't move it, you don't touch it, you don't fuck with it, all right? Until you're a more advanced trader and you can start to add some discretion, which we'll cover as well. And finally, risk management is not moving your stop up to break even. It's one of the biggest mistakes I see. Moving a stop to break even is trading out of fear. It's altering your plan. It's introducing an extra decision. It's also adding complexity to a trade that doesn't need it. Okay. Again, you can build in a rule into your system where you do move stops, but typically on scalping and short-term trading and day trading, you don't move your stop to break even. Because what a lot of people do is, moving a stop to break even is, let's say you take a trade on Bitcoin over multiple weeks and you buy it at 40 and you're targeting 60 and your invalidation's 33, 34, and it dips down to 37 at the start of your trade. Then it pumps through, breaks structure bullishly to the upside and pumps up to 45k. All right, so it dipped down below your entry, it pumped way back above it, and it's holding above now. At that point, you can say, okay, my stop loss doesn't need to be as low as 34 anymore. I can move it up to 37, 38, 39, maybe even up to break even. But that's because it's a much longer term trade. It's multiple weeks, and it's a trade that's going to develop in terms of structure on an hourly chart, 4-hour chart, and a daily chart for you to track. So you can more reliably move your stop. Now, if you move your stop on a scalp, if you got in at 40, targeting 41, and your stop loss was 39.5, just because it pumps to 40.5 does not mean that you can move your stop loss up to 40. Yeah? Because price on an intraday basis is going to fluctuate 1, 2, 3, 4% in either direction every day. So, and the reason it fluctuates in between those is because it's hunting the stop losses of people like this who move their stop to break even, or trailing, put in a trailing stop, or they lower their profit target, raise their profit target, lower their stop loss. Anyone who fucks around with their trade on a scalping basis gets hunted, right? So, with that out of the way, cover what risk management is. in my opinion, now this isn't an exhaustive list, but this is the most important key elements for it. The first most important is to understand the max drawdown probability of your account, of your trade, of your system, and we'll cover that in the next slide. Using a hard stop every time is risk management. Now, caveat on this, hard stops are essential in day trading and scalping. People will tell you don't need a stop loss if you're trading over longer time frames, and especially if you're trading with no leverage over longer time frames, and that's absolutely true. I believe that if you're using any amount of leverage, you should always have a stop loss, regardless of the time frame of your trade, whether it's days, weeks, months. But if you're trading spot, of course, you don't need a stop. You just set alerts for invalidation, and whenever it pings, you can decide then whether to close your trade or not. Now, that doesn't apply to us. We're talking about scalping and short-term trading here. You always must have a stop loss in place, because you're trying to minimize risk and you're trying to trade with a risk-reward mindset, okay? So your stop loss or your invalidation on a scalp is not going to be 40% below price or 30% below current price. It's going to be 2, 3, 4, 5, 6, 7, something like that, within that under 10% range generally. Because on a day trade, or a scalp, you're trying to get, let's say it's not Bitcoin, let's say it's a slightly more volatile asset. Let's say it's like Avalanche. Well, Avalanche can move up and down 10% every day, between, on a quiet day it moves up 3 or 4%, on a volatile day it goes up 11, 12, and the same on the flip side with going down. So if you're looking to trade that from a scalping perspective, you're trying to risk maybe a 4%, 5% swing, depending on where the market structure is, to gain maybe a 10%. So you're trying to get a 2 to 1 hour trade, 2 hour trade, sorry. Now, we know what happens in crypto is that whenever a crash comes, and a flash crash, and whenever a liquidation cascade starts, it goes down 30%, 20%, 40%, whatever, very fast, within minutes sometimes, and generally hours at most. So if you don't have a stop loss, you're going to end up taking a 40% L instead of a 5% L, okay? So you always have a hard stop when scalping or day trading. Look, you'll take some L's, that end up going in the direction that you did want to trade. So sometimes you'll be long, you'll have a stop loss, it'll hit your stop loss, and then the price will go up anyway. But over the long run, you're going to come out on top by limiting your risk and by being disciplined. So having a hard stop removes the most dangerous element of trading, which is you being a retard. That wrecks more traders than anything else. The whole point of having these defined rules, sets, systems, stop losses, it's all designed to remove the human element of error, and to stop from bad decisions turning a good trade into a loser. Risk management is also having a soft stop, okay, or what I call an early invalidation. So, kind of building upon the previous point, when scalping, you should have a stop loss at a defined point where it absolutely must cut to reduce your risk. Now, when you become a little bit more experienced as a trader, you can also have an early invalidation, which isn't a stop loss. You don't load it on the system. It's not an order you set on your exchange. It's a level that you set an alert at, or a level that you just keep track of, that if price breaks down below, your thesis is probably wrong, not definitely wrong, and that if other factors are going against the trade, you can consider cutting it, okay? But again, that's a more advanced one, so that's not something you're going to focus on for your first few hundred trades, because you need to learn the mechanical side as well, like I said, about the science versus the art. You need to have as little discretion in your trading plan to begin with, but it's important to mention it here because over time, when you do start adding discretionary decisions into your trades, one of them will be when to cut trades early, right? And you see the difference in that versus the point above, which is cutting trades early because you feel it's going against you. That will typically happen when you haven't preset a level. Yeah, so if you just ape into Bitcoin and you put a stop loss at some random place and then price is going against you and you're like, oh, I feel like this is going to go, it's going to stop me out, and you cut it and then it goes up instead of down and you would have made more profit, that's a bad trade. Having a soft stop, which is before you even buy, you're saying, I'm buying it at 40K, my hard stop's at 38K, but I have a soft stop in mind at 39K that if we start trading below that and there's something else bearish, like, maybe the traditional markets like the S&P is looking like breaking down, it's rolling over, there's some negative economic data coming out that would be bad for risk assets, blah blah blah, whatever, then I will consider cutting it early, right? And you see the difference in those two things, where one of them is based on emotion, the other one's based on reason and logic. And finally, risk management is using a trade planner. So managing risk goes beyond just how much of your account you risk per trade. So it's not just about saying I'm going to put 1%, 2%, 3% up or whatever. A planner is very important. So planner, journal, whatever you want to call it, is actually designed to help you not take trades rather than take them. Okay, so most people will see a journal as something you do after you're trading. So you go off, you load up FTX, you start aping into coins all day, you buy high and you sell low, you have a fucking shit day of trading, you use too much leverage, you get 10 trades, you win 2, you lose 8. At the end of the day, you sit down, you open up an Excel spreadsheet or you open up a Google Doc and you go through each trade one by one and you journal them. Entry, exit, stop loss, whatever. And you're like, great, I journaled for the day, I plan my trades, same again tomorrow. No, obviously not. That's fucking stupid. So you can't just plan your trades so you can't just journal your trades. You should plan them, but most people don't. You can't just journal your trades and then say, oh, I'm following a process. You could just do horrible trade execution. And just because you write it down in an Excel spreadsheet, you can fool yourself into thinking you're a pro trader. What the planner will do is help you to understand what you trade best. So what assets you trade best, what conditions you trade best in, trending or ranging, what days of the week you trade best on, what times of the day you trade best on, everything, anything you can think of. And that's a combination of pre-planning. So before the day of trading, you'll say, my plan today is to trade around the New York Open, which is 9:30 a.m. Eastern time. I have my levels set on the chart, support and resistance. And if Bitcoin trades into support or trades up to resistance in and around the New York Open, I will go long or short accordingly if my plan permits. So that's planning. Then you also journal it. So when you take those trades, you do journal them. You write down not just entry, exit, stop loss. You write down how the trade developed, why you entered it, how it eventuated, so what was the outcome, what you learned from that. And learning is not just did it win or lose. You learn how price moved, whether the trade was, in hindsight, whether the trade was a good trade to take. And again, a good trade to take does not just mean winning or losing. You can win a trade by just being lucky, or you can lose a trade even though you did everything right. So the journal will help you keep track of all that. And then over time, when you look back and you analyze and you update your own trading model, you will see, okay, today I took 3 trades, all of them were losers, and we were on a trending day. So Bitcoin at the open, gapped up, pumped up straight away. Say it was the weekly open, and continued trending higher. And I took 3 short trades because I thought that it should go back down. It had been bouncing up and up and up, and I was thinking it's going to break down eventually, and it never did. Lost 3 trades, and when I look back through my journal and my previous trades over the past 2 weeks, the days on which Bitcoin has been trending, I have a 20% strike rate of winners. The days when Bitcoin has been ranging, I've been getting a 70% hit rate of winners. And so then you can start to identify, okay, either I'm a better range trader, as in I just trade those conditions better, or the specific system I use is currently best suited to range trading. And it doesn't mean I can't trade trends, but it would mean I would have to build a new system that would be a better trend following day trading strategy. So then you can see immediately how you're improving. So you can say, okay, with this current system, this rule set that I have, I'm going to now add an additional rule, which is no trades on a trending day, only trades on a range day. And plus, also put a note in to build a new system and test it out on trending days. So you can see how having the trade planner plus a journal follow-up creates a much better, more professional approach to trading. All right, rule 26, respect the maths. And yes, it's maths for all you Americans. So many people don't understand the basics of statistics and probability. In lesson 3, we're going to take a more deep dive on that. But in terms of risk management, it's important to understand the core tenets. So what you can see on the screen is a visualization of the probability of various losing streaks. Okay? So on the horizontal axis, you can see what the probability is in percentage terms of seeing at least X number of consecutive losing streaks within a 50 trade period. So we've got two losing trades, 3, 4, 5, 6, 7, 8, 9, 10, and 11 losing trades. So what's the probability of seeing that number in a row